bring in Walter Isaacson. He is Perella Weinberg Advisory Partner, a Tulane professor, and a CNBC contributor. He's also the author of biographies on Elon Musk, Steve Jobs, many, many other luminaries. And Walter, this is
huge.
Really a big deal, especially after what we saw last week with the DOJ taking on
It's
Apple.
totally huge. And in some ways, it's both sides of the political spectrum, especially in the United States, are taking on this notion of the bigness of the tech companies, for better or worse. And it goes all the way back to U.S. v. Standard Oil, where Standard Oil was tying its products to other fields so that you had to use their gas stations, their distribution lines. They would, and this was ruled illegal. And you're seeing it with U.S. v. Microsoft about 20 or 30 years ago, and now Apple, Google, Facebook are all in the line of fire.
Are what these big tech companies doing similar to what Standard was doing? I mean,
absolutely. It's tying and bundling. Now, what Standard Oil said, what John D. Rockefeller said is it's good for consumers. It makes it cheaper. It's much more efficient. And what they came up with back then is a standard that says there's two prongs, what harms consumers and what harms competition. And you shouldn't do either. And it's very similar, because if I search Google, instead of necessarily sending me to websites now, it gives me its own products where I can make a reservation. I can go to, likewise, Apple ties in its payment system to other things. This is good for consumers sometimes. Steve Jobs was great at wanting to have sort of one big ecosystem that was seamless, but it does mean competitors can't come along. And let's remember that if they hadn't done that to Microsoft when it tried to bundle search and browsing and everything into its operating system, you would not have Google now.
Okay, that's a very interesting perspective, and one that makes me think this is going to have a lot more teeth than maybe some of the guests we have spoken to about this.
Well, it's got a lot of teeth because you got the FTC.
Well, Apple has said that they're doing it because of concerns about privacy for their customers and concerns about cyber attacks potentially coming in. Can you do it for those reasons if they can't prove that you're doing it for anti-competitive reasons?
Well, it's true. Apple is doing it for privacy reasons, and it's pretty good. I like buying things through Apple because of that. Right. But it also means if you're CNBC, if you're Time Magazine or something, you do not get direct contact to your consumers because they're the ones that control payments. In other parts of the world, we have these mega payment apps. We were talking about Elon Musk a moment ago. He's trying to make X into a super payment app where you can transfer money and do things on that. These things could not work right now in the Apple ecosystem, except for if there's pressure from the antitrust folks.
And your point was, we're glad we have Google?
I am.
No, kidding. I'm kidding. I'm kidding.
Well, no, but my point was...
Well, how do you know that the Microsoft product wouldn't have ended up being... Google's got its own issues, obviously.
Obviously, but the point is,
I'm glad we have it. But you're sure that this is the same with Apple? I'm not sure that it's directly comparable. What we're talking about.
Well, what's happening is it's comparable to me because it's actually good for consumers, the way Becky said, which is your privacy is protected. It's one nice ecosystem, but it's bad for competition. Meaning these other payment systems, other apps won't develop.
Right.
And we want in America, where my students at Tulane, and they come up with a great idea of how to do something, they don't want to have to then go to a venture capitalist.
I think most of the time,
yeah,
I know, but most of the time the competition in this country is from innovation and entrepreneurs, and it's not, I don't immediately think, wow, innovation is being stifled by these big companies. I don't immediately think, I look at the guests we have on, I look at the 50 disruptors that we always talk about at CNBC. I don't think the government needs to come in and decide that Apple is too good at what it does. And companies, by definition, try to do better than their competitors. Correct. And it becomes almost a subjective viewpoint about whether kicking your competitors' butts because you're good is different than using antitrust, something that's outlawed.
That is such a key point, which is in America, if you get really, really good and do things, you can get dominance in your field, and the law shouldn't do anything about it. But what the law says, ever since US v. Microsoft, is you can't use that dominance, say in the smartphone business, to then get dominance in an adjacent or other field where you're crushing competitors.
You don't think that the current
systems.
antitrust sentiment from Lena Khan and from Cantor, you don't think it's they've the pendulum? I think they're out of their minds. How far they've gone.
I think the pendulum, of course, has swung, and it's swung in a historic way, which is it used to be this two-pronged approach: hurt consumers, hurt competition. Both were bad. Then for the past 50 years, you had the Chicago school that said, let's just focus on consumers. It doesn't hurt the consumers, no harm, no foul. That's sort of the position you argued a moment ago.
Right.
I think they're going back to saying there are two prongs. We want to protect competition as well as consumers.
It's like the Fed having a dual mandate, but they decide.
Dual mandates are hard.
We've seen the European model of protecting competitors. How's that work for innovation?
Very well, and Europe has not been great in innovation. If you want to say what's going too far, the Digital Marketing Act, which is what's being used this morning to go after the big companies such as Google, right. I'm a little bit more skeptical.
So I'm trying to play this out from the market's perspective, because it's been these big tech companies that have really been driving things. Even this morning, Goldman Sachs is saying they're looking at a base case still of the S&P ending the year at 5,200, but a team of their analysts is saying, look, we could see big tech driving it up another 15% to 6,000. If these cases are successful, even if they're not, if they drag out over a period of years, what does that do for the potential of these companies to flourish?
I think your question of dragging it out over years is actually the relevant one. That's what happened with Microsoft. There are very few people who can actually remember who won in the end on the US v. Microsoft, where they were trying to bundle the browser and many other things into the operating system. You know, Apple lost the original case, and they didn't do, I mean, Microsoft lost the original case, but then there wasn't a remedy of breaking up.
But Bill Gates said it was like why they missed out on the phone.
And what it did was it constrained Bill Gates from doing a mobile operating system, from doing social media. Well, that's good and bad. It means that Apple gets to rise. It means that social medias like Facebook get to rise. We want the creative destruction of competition in this market, and that's what's going to happen with these cases. They won't get solved.
Short week for traders. The markets will be closed for Good Friday. Joining us right now to talk about the week ahead and beyond is Lori Calvasina. She is RBC Capital Markets head of U.S. strategy. And Lori, we have seen the markets really have a pretty phenomenal year to this point. I think the S&P has already set 20 new highs before we even reach the end of the first quarter. You're looking at all of this, and your target for the S&P 500 is below where it stands right now.
Yeah, and look, I think this is one of those moments, right, where we're taking on a lot of information and digesting some conflicting cross currents, is how I put it. So I think if you want one stat that just sort of explains why it's been such a good year and why it could continue to get even better, just look at GDP forecasts. So a consensus is right now looking for about 2.1% this year. And to start the year, it was closer to 1. As recently as mid-February, it was about 1.6. Last summer, it was 0.6. So this whole idea that we're on the brink of recession, that's just been brushed aside. And now the debate is, how hot is the economy? And one of the most common, sort of worry points I hear from investors over the last month or so has been, is the U.S. economy so hot the Fed can't possibly cut? It is a mirror.
It's such a weird worry, right?
Yeah,
when you think about things.
And it's so weird if you think back to last August, when people were like, well, the Fed isn't going to cut, inflation's going to be sticky, and they're going to drive us right into a recession. So it's the same worry, the Fed's not going to cut, but it's just the complete opposite in terms of the economic setup.
Okay, so this weird cross currents, I think about all the people that are trying to figure this out right now. The Fed's facing the same problem.
Right.
Do we cut rates? Do we stand pat? A few months ago, or even a month ago, we were asking if they'd have to raise rates because inflation has been hotter than expected. Goldman Sachs has kind of a weird way of dealing with this today. I think they're sticking with their S&P target of 5,200 for the year end. But they've got another group of analysts led by David Costin, who's saying there is a chance that big tech is going to take this all the way, the S&P 500 all the way, another 15% higher to 6,000. So how do you do that? How do you kind of, as somebody who's responsible for saying where the markets are going to be at the end of the year, how do you figure it all out?
So the way a lot of us do it, we'll say this is our base case, this is the bull case, this is the bear case. And, I will say even within our own mind, modeling. We have this one valuation model, and we run all kinds of stress tests on it. If I just take current consensus projections, it points to 5,400 on the S&P at the end of the year. If you use my earnings number, if you use consensus, it's 5,700. Now, I actually don't really believe those consensus estimates right now, so I ran a new stress test where I kind of softened them a bit, basically reflect what's in the Fed SEP. I point you to about 5,300 on my earnings number and about 5,500 on consensus earnings. So I see a bull case that seems very, very reasonable to me. The problem is if you look at sentiment and how quickly, again, the markets have come. So the CFTC data on buy-side positioning is actually above levels we saw in early 2018, is above levels we saw in February 2020 pre-COVID, and it's above all the highs we've seen the past couple years. If you look at AAII net bulls, you're one standard deviation above the long-term average, and that's consistent with a short-term pullback in the market and kind of muted gains over the next 12 months. So yes, there's all this great news. Have we priced a lot of it in? Markets are funny. They often run hotter than they should, especially in recoveries, and we think this is kind of a weird recovery we're in. But you have to acknowledge the sentiment data is sending some pretty, sort of nasty signals right now. So as a strategist, we try to balance all of that, and sometimes it doesn't always line up perfectly. Usually the sentiment can get resolved pretty quickly, and then markets can kind of recover and march on, and that's kind of my assumption right now. But I'll tell you, Becky, I've been looking for a pullback for 3 months, and we haven't gotten it.
And you're not alone. I mean, I would say this is a really weird year, but then again, you could say that probably about every year. You think to 2019, nobody was predicting or expecting that we'd have a global pandemic that would shut down economies everywhere.
I think that's fair. And I'll tell you what's kind of made things make a little bit more sense in my head to me, and I've been talking about this a lot more. We wrote about it a bit this morning. I think we came pretty darn close to a recession in 2022. We had 2 negative GDP quarters. The stock market priced in a recession, had a similar drop. Consumer sentiment on the Michigan survey went to recession lows. Inflation spiked the misery index spiked because of inflation, not unemployment. And you kind of felt as bad as you typically do in a recession. So I think we're in this weird recovery that nobody understands because...
Okay, so that's crazy. Yeah. We've already had the soft landing, essentially. We had the landing and we've taken off again?
I think we actually had like that W. Remember back in the pandemic, we were debating all the letters, and I think we kind of had like a baby...
I forgot about that until you just said that.
Yeah, but it was like this whole V-shaped recovery. Everyone, thought people were crazy for saying that, and we basically had that, but I think you kind of had like maybe a shallow, kind of other V on the other side of the W. And one thing about recoveries coming off of big crises, we tend to underestimate everything. People get PTSD and really just sort of underestimate earnings, underestimate the economy. And I think that's what we've done on the economy recently.
So forget about the base case. What do you think is most likely? The most likely
I think that we're going to have some choppiness at some point this year. I think we're going to have a little bit of a pullback, somewhere between 5 and 10%, maybe closer to 5 because everybody wants it.
That's not much of a pullback if you're an investor waiting to get in.
It's not. And, I think we're going to have some choppiness. I would say there are kind of 2 camps of strategists right now. There's the constructive camp and there's the sky is falling camp. And I'm definitely not in that latter.
Lori, what's your total? I remember when Trump was on, he said prices are up 50%. They're not up 50%, but they are up. I don't know what number you would use. Probably, I think 30 is probably about right.
Like inflation, or
from the when you have a couple of years, when you have a couple of years of much higher than expected, and then it slows to 3 or 4. You've still got the couple of years of much higher than I just know from going. Maybe it's the supermarket I go to. It's so expensive, but. I can feel it. I still feel it. And wages, have they caught up? I mean, are people now does their dollar go as far as it did 3 or 4 years ago?
Well, look, I think in terms of like food prices, right, and all the things that we're sort of confronted with on a daily basis. I mean, I have 2 small children, right? So I see this in terms of how much it costs to stock my refrigerator.
That's what I mean.
Yeah, I'm right there with you. And
gas prices, I mean, they're down, but
they're not great, but they're better. And I think you have had some wage catch up that has helped offset a lot of this. I think you have different consumers feeling things differently. So the low end, that's what we continue to see signs of a bit of a crack. If you read through like all the food companies, for example, right, or other consumer companies, they are more sensitive to short-term interest rates than high-end consumers are. High-end consumers have done all the same things, right, that companies have done, termed out their debts, locked in low mortgage rates. So they're able to offset some of these things like higher grocery prices a little bit better than the lower end. But people are feeling.
The market right now on track for its 5th consecutive months of gains. Joining us right now to talk about it is Stephanie Link. She's Chief Investment Strategist and Portfolio Manager for Hightower. And Stephanie, I don't know if you heard in the last block, but we were talking a little bit about Raphael Bostic saying at this point he only sees one Fed rate cut this year coming up. I don't think you think it matters all that much what the Fed does because you are paying attention to the underlying economy.
Yeah, exactly right, Becky. The numbers last week, or the commentary last week from the Fed, basically adjusting GDP higher was a very good sign. We've been talking about the resiliency of the economy for such a long time. So it's nice they're finally realizing that. They also made progress in terms of on the inflation front, and we have seen that. We're down from 9% inflation to about 3%. We still have a little ways to go, but the underlying fundamentals of the economy are strong. And I don't think it matters if they do 1 cut, 2 cuts, 3 cuts. Maybe they don't even do any cuts this year. But the point being is that the economy can handle where we are at the moment, and that bodes well for earnings, and that bodes well for stocks. And most importantly, it bodes well for a broadening out. I was looking at a variety of different sectors this morning. You know, technology year to date is up 9%. But if you look at energy, industrials, and financials, they're up 10% year to date. And so the market is broadening. We've had fits and starts with the broadening out, and then it narrows and that sort of thing. But I am very encouraged by this broadening out because it speaks to stronger earnings across the spectrum.
The basic underlying economy, what that means, I mean, you just bought shares of D.R. Horton this week. Is that part of why you're doing this? I think housing is your favorite sector.
Yeah, well, we've talked about Home Depot, we've talked about Masco, Sherwin-Williams. Those are all names that I like. D.R. Horton is actually the cheapest of them all. It's only trading at 11 times. Historically, it's at 13 times. And I think all the data last week that caught my eye was the housing data. If you look at housing starts, they rose 10.7% month over month, and they were revised higher for the prior 2 months. Single-family homes were up 11.6% month over month. And the most important number, the permits, because that is leading indicator. You're running up permits almost 30% higher from a year ago level. So that's really encouraging. And of course, we also got good home sales as well. Cash buyers are up 28%. First-time buyers are up 25%. So I look at all these numbers and how do you not be bullish on the housing sector? And with D.R. Horton, seasonally, this is the time when you want to own it and other home builders because you see orders inflect from this quarter versus last quarter as much as 50%. And why I like D.R. Horton is because they do cater to that first home buyer and in the Southeast markets, which are really quite strong.
We were just talking about how Goldman Sachs is reiterating its year-end target for the S&P 500, but they do have the analysts led by David Kostin who say that what you could see is there's a chance for the mega cap tech stocks to really take the index much higher, up about 15% between now and the end of the year. We have been looking, though, at some of those big tech stocks that have really been struggling. Apple's down 6% over the last month. You had the DOJ bring its case finally last week that we'd been hearing rumors about. I mean, that's a really big potential overhang, and there are people questioning if that could do to Apple what the DOJ did to Microsoft several decades ago.
Well, I think there's a lot that we still don't know, and I think it's going to take a very long time before we get any resolution. If you go back to Google and their DOJ case, it's going to be a 6-year situation by the time we get some sort of a reconciliation there. You look at even Apple with their ebooks issue, it took 4 years to get to a resolution. Microsoft, 3 years. So I think you're going to be, we'll be talking about this for a while, but I don't think we're going to get any kind of firm indication for quite some time. In the meantime, the stock is down 14% from its highs. And I think the April quarter has been de-risked because they already lowered numbers, as you recall. I think you're going to get a new buyback program announced as well during the April quarter of about $90 billion, maybe a little bit higher. And then, of course, you've got the AI meetings, WWDC in June. And I think it's very interesting that they've been doing M&A in A&I, and they shut down cars so that they can actually use that $1 billion that they've been spending on the car market back into AI. And so that's one of the reasons, all of these reasons actually are reasons why I've been recently adding to the position, because I do think long term this is going to be just fine.
You've owned it for a while.
I have, Becky,
yeah.
but Yeah. Well, you know what? I've owned it for a while, but it was a very, very small position. It was only 1%. At one point last year, it got to 7% of the benchmark. So I was underweight quite a bit. Now I'm about 500 basis points overall in the position. And so it's much bigger. I feel like it's really out of favor at this point as well, for obvious reasons, but I think that's your opportunity.
Breaking news from Boeing CEO Dave Calhoun will step down at the end of this year. Let's get to Phil LeBeau. He's standing by with Dave Calhoun. Hey, Phil.
Thanks, Joe. Dave, thanks for joining us here. You heard what Joe said, stepping down at the end of this year. Why now? And was this completely your decision?
Yeah, first of all, 100%. Why now? I've entered my 5th year. At the end of this year, I'll be close to 68 years old. I've always said to the board, and the board has been very prepared, I would give them plenty of notice so that they could understand and plan succession in regular order. And that's what this is about. It's me giving them notice that at the end of this year, I plan to retire. And then them taking the actions that they've taken. I'm actually very proud of the way the board has handled everything. Very deliberate. The move with Larry, in my view, very deliberate. The entry of Steve as our new chairman, very deliberate. All very qualified and great decisions.
If you're going to be leaving, some will say, why not just leave now? Why wait until the end of the year?
We have another mountain to climb. Let's not avoid what happened with Alaska Air. Let's not avoid the call for action. Let's not avoid the changes that we have to make in our factory. Let's not avoid the need to slow down a bit and let the supply chain catch up. We got to get at that, just like we got at the rest. And we will get through that. We will get through that. And I've committed myself to the board to do exactly that.
You've got 2 other big management changes. We'll talk about the board changes in a bit. But you've got Stan Deal stepping down,
Yep.
resigning as head of Boeing Commercial Airplanes. Stephanie Pope, the COO, moves into that position.
Yep.
What does she bring to the table that is different from Stan?
Well, the big thing here is, first of all, Stan is retiring. This is all about a clear path to give our best people internally an opportunity to shine in front of the board, demonstrate everything that they can do. Stephanie's track record speaks for itself. She has been a leader in every position she's had. She has seen every part of the company. She has most recently led our global services business. It services both our military customers and our commercial customers every day, all day, taking calls, responding, doing the work. She has really differentiated herself. So the move we made at the end of the year to put her into a chief operating officer position was a very deliberate move.
As you know, just last week, airline CEOs went to your board, went to Larry Kellner, and they said, we want to meet. We want to talk with the directors directly,
Yep.
but we don't want to hear from Dave Calhoun in this meeting. We don't want Stan Deal in this meeting.
Yeah.
When you first heard about that, what was your reaction?
Well, first of all, I would just take issue. I know all the people they call, and I know all of that, and I talk to them every day, all day. I don't think it was anywhere near that kind of messaging. Our board and I talk to our customers every day, all day. We've had a CEO come in and talk about the accident, talk directly with the board, and I volunteered to leave that meeting because I want clarity. I want transparency. That's what we all want. So, yeah, I understand. You know, if you put this in context, they run an everyday, all-day business. I run a long cycle development business, and a long cycle production business has to deliver them a perfect airplane. And so those two things, when they meet and they collide, it creates this kind of environment. And that's the environment we're in. But I listen to our customers all day.
Do you understand their frustration? Because I heard from airlines last week, they said, we want concrete action. We want concrete steps to make changes.
I think the news that Brian West had to deliver just earlier this week to the financial community about the slowdown in our factory, our determination to get ahead of that, I think that will demonstrate and be a proof point on just our intent to get ahead of it. We will get ahead of it.
Have you told FAA Administrator Mike Whitaker that you're resigning or retiring at the end of the year?
No, I would never preempt the board in communicating to anybody, but the FAA is with us all week this week. We will go through a 30-day plan with them. Then 30 days later, we'll go through 60, and 30 days later, we'll go through a 90, and we're going to have to demonstrate progress in each one of those moments. And it's a pretty constructive approach, both from the FAA and from our team.
Last week, Mike Whitaker was interviewed by NBC, and he said that when he was out here, what he saw was a culture of move the product, move the plane. It was not a focus on quality control and safety management.
Yeah.
What was your reaction when you heard those comments?
Well, I recognized exactly what he was talking about because I heard it from all of our own people. Remember, we did a stand down immediately after the accident, and we listened to all our own folks. And we have this bad habit in our company, and actually in many large companies that have to assemble big products. When you do work out of a position, the message you send to your people is, and maybe that work was moved because of a shortage, maybe it was because you're trying to fix something that was non-conforming, but when you move it down the line, it sends a message to your own people that, wow, I guess the movement of the airplane is more important than the first-time quality of the product. And we have got to get that in way more balance, without
Dave,
a doubt.
You've been on the board since 2010, 2011. This is not a new criticism of Boeing.
Yeah.
This has been out there for years, that you guys are about pump the product, pump the product, pump the product, and not enough about quality control.
Yeah,
how do you change that?
Oh, you slow things down. You catch up. And just a reminder, in 2020, we didn't produce any airplanes in the MAX line, 0. 21, we started the line back up. So we were going from 0 and slowly, steadily increasing our rates. At that very same time, with insatiable demand on the customer side, we had a very sporadic supply side. And so these forces that have been with our industry for a long time probably got even more pronounced, without a doubt. And so our job has to be to sort of say, nope, raise our hand. Everybody has to be able and capable of raising their hand and stopping a line if they have to. And that is the premise for going forward.
So, Stacy, as you digest what Christina just said, talk to me about why you haven't changed either your models or your forecast, your price target forecast on these stocks. Do you agree with what apparently some of the executives have told Christina, that it's really, my word, not theirs, immaterial?
Well, that's not what Christina said. She was talking more about the export controls, right? This may be different or incremental. We don't know yet. You know, you can look at the exposures, and you sort of talked about the, Intel 27%, AMD 15%. That's not exactly the right number, though. Those are sales into China. It doesn't necessarily reflect actual consumption in China. Just like a lot of PCs, for example, are put together in China. That'll all show up as Chinese revenue. If you look at the end market shipments, PCs and servers, China's responsible for maybe 15% of total PC consumption. Non-consumer is 2/3 of that, so it'd be about 10% of the world's PCs go into like non-consumer stuff into China. Government's a portion of that. It's probably low single digits, would potentially be impacted over time if this actually comes to play. Servers, about 30% of servers ship into China, and again, like government usage of servers in China, it's probably fairly small. You can roll that through the numbers for both Intel and AMD, and we did that. It's probably low single-digit percentage of revenue, probably worst case, I think, for both of them. It's Intel's earnings worse because they're less profitable, and so if you take a similar chunk off of both of them, it actually hits Intel worse. But there's nothing to change yet, if that's what you're asking. Like we saw this announced. Apparently, these rules were actually put in place in December. They may be actually starting on the procurement process to engage those rules now. It's probably not anything like as a cliff. Like it probably takes, like it'll happen over time, assuming it happens at all. And there are other issues, I think, right now that are going on with both stocks that are probably bigger or like more near-term things to worry about than this anyway. So there's nothing to change yet. We'll just see how things go, I think, as things progress over time.
But, Stacy, nothing to change yet, but do you see this impacting the trade wars and all the other conflicts? And do you think that could escalate the way these stocks or these products are treated in terms of Chinese exports?
I mean, look, so you look at the magnitude of this versus what the U.S. has done for export controls, and certainly the U.S. efforts are a lot bigger. You have to remember, that's by design. China doesn't really have a lot of leadership in any of these areas. Like what China can do to push back specifically in semiconductors is very, very limited. They don't have any leadership in those positions. The U.S. is kind of holding the cards. We'll see if there's broader escalations around the trade wars and the prior tariffs and the export controls and everything. China's got other elements that they could use that maybe are not in semiconductors. There's other materials that they drive. There's things like M&A approvals, and we've actually seen some of that, right, in some other areas. But I think within semis, they're doing what they can, maybe to send a message if nothing else. But the actual impact they can have on this is not that big relative to what the U.S. can bring to bear.
Stacey, your point really quickly. You talked about the percentage and all that, and I know I mentioned 27% and 15%. It seems like a similar narrative that the companies are bringing up and saying these chips are just coming through our country. It doesn't necessarily represent consumption, but this is an opportunity for to strengthen Huawei, right? We haven't really spoken about it. It was mentioned briefly with Eunice, but that Huawei or ARM processors too, given that they got the green light and they have ARM China a presence over there as well.
Yeah, maybe, right? So Huawei, they were put on the entity list. They started to do their own smartphone chips, for example, leveraging SMIC, which is a Chinese semiconductor foundry manufacturer. The parts are not as good. They can't rely on sort of the bleeding edge equipment and technologies. But I mean, if you don't really care about cost and performance, you can do all kinds of stuff to sort of get around that. And they're doing that on smartphones. Maybe they start doing it on PCs. There are other vendors. I think you put the list up on the screen earlier. Some of those are ARM vendors. You had Hygon on there as well, which actually does x86 in China. It's the remnant of a JV that AMD had with a Chinese entity like years ago that CFIUS shut down, but that IP is already over there. And Hygon is actually making x86 server chips in China today. So there are alternatives that you can bring to bear, and we'll see how big that can get.